Okay. So, on behalf of Sustainability Reporting Standards Board of ICAI, ICA Hina Bora extends a very warm welcome to all of you to our 25th session of our webinar series, Demystifying Sustainability, Catalyzing Growth. Today's session is centered around a critical theme, which is responsible investment with focus on ESG due diligence. We are very honored to have with us a very esteemed speaker, Mr. Vishal Bhavsarji. Welcome, sir. Let us now begin, and I would like to invite CA Kirti Agarwal to kindly take the session forward. Welcome, Kirti.
Yeah, good afternoon, everyone. So, today I'm here to introduce the speaker, the chairperson of the Standard Board, CA Preeti Paras Salva. So, CA Preeti Paras Salva is a Central Council member and also holds key roles as the chairperson of Sustainability Reporting Standard Boards and Young Women Excellence Committee. She is also the vice chairperson of the Corporate Laws and Governance Committee and Group on Enabling Lifestyle for Environment Life, and is also on the Board of Discipline and other committees. Internationally, she represents India on IFRS Foundation's ISSB Sustainability Standards Advisory Forum and has chaired the SAFA Sustainability Board. In the corporate world, she serves as a public interest director at NSC Clearing Limited and is an independent director and audit committee chairperson for several leading companies. Her contributions extend to social impact initiatives as directors at the Institute of Social Auditors of India and as a governing council member of the Social Stock Exchange at BSE. She is also a noted speaker and a mentor, and she has been instrumental in launching several noteworthy key initiatives in Sustainability Board and Young Women Excellence Committee of ICAI. So this is the introduction for our chairperson, CA Preeti Salva. So now I would also like to introduce the vice chairperson, CA Dr. Sanjeev Kumar Singhal. So, CA Sanjeev Kumar Singhal is a Central Council member and a distinct chartered accountant with 26 years of professional experience. Currently serving as a partner at SR Bartley Boy and Company, he is also the founder chairman of Sustainability Reporting Standard Board and currently chairing the Accounting Standard Board and Group on Impact Financing and also vice chairperson of Sustainability Reporting Standard Board and Development of International Trade Services and WTO Directorate. He has a significant involvement with SEBI and Niti Aayog panels on sustainable development goals and social stock exchange. Intentionally, he has chaired 39th and 40th sessions of UNCTAD ICAR and participated in various global standard setting committees. He is a prolific speaker and an author, with over 1,200 lectures delivered worldwide and numerous publications on accounting standards. So now I would like to hand over the mic to CA Hina Bora to introduce the speaker for today's session.
Give me 2 minutes. Give me a minute. I'm some network issues. Okay. Sorry. So today we have with us CA Vishal Bhavsarji. Vishalji is a sustainability professional, having worked in diverse consulting and corporate roles for past 20 years. He is currently working as head ESG for a private equity firm, Multiples Alternative Asset Management Limited. He has unique blend of consulting and corporate experience in driving ESG and sustainability and making business further future ready. He has deep expertise towards making sustainability integral part of business decision making. He has also earlier worked with ENY as a consulting professional in areas of sustainability, climate change, energy efficiency, and renewable energy. He has also worked with other large conglomerates like Tata Mahindra and Aditya Birla Group. He has been associated as a catalyst with MIT Climate Collab project that is driving global effort on climate mitigation. He has also worked as ad hoc expert with United Framework on climate change conversion on various climate change assignments. Currently, is also associated with prestigious global projects on ESG. He is on technical advisory committee of Science Based Targets Initiative. He is a member of Sustainability Reference Group, which is constituted by FIRS and Human Rights and Social Issues and Spring initiatives are also run by PRI. He is on a global advisory committee of RE100, which is a program run by the Climate Group. In free time, he enjoys hiking, reading, traveling, and other sports. And with all this experience and also such hobbies, I would like to welcome you, sir. And thank you so much for your time. I hand over the mic to you without taking any further time. Thank you so much, sir.
Thank you, Hina and Kirti, both of you. And also many thanks to Preeti and Sanjeev for inviting me for this session. I'll just share my screen. You can confirm and then I'll begin.
Sure.
Can you just confirm if the slides are visible?
Yes, please.
Yeah, yeah, yes.
All right, okay. So, Hina has already introduced me, but a quick recap in terms of I've worked in this field for more than 20 years, almost 2 decades. Just one small correction, I am not a CA. I am not a
Okay.
practicing CA, but yeah, I've worked in this area. I've worked initial part of my career on consulting side. I've advised a lot of clients in area of sustainability and ESG, and then second half of my career, I've worked with a large business house here in India. And in my current role, I head ESG at Multiples. It's a mid-market private equity firm based in Mumbai. We raise capital in terms of business model for a PE, just for the context of the audience here. We raise capital from large institutional investors globally. Plus, we also raise capital from domestic sources, and we deploy that capital in form of various funds. That's how normal private equity business run, right? And as part of this investment cycle, we have been looking at ESG as multiple since the beginning. Multiple is about a 15-year-old firm. But since the inception, ESG was one of the core pillars of investing for us. So today's presentation, I'll touch upon very quickly in terms of why ESG is relevant from a private market standpoint. And I understand there are a lot of chartered accountants or CA practitioners. So they will be engaging and working with different companies, maybe a PE firm or an investment firm, but they in their capacity they'll also be working with a lot of unlisted firms. So from that context, this will be of relevance to the audience today. Just to begin with, this is a picture or a comic strip in terms of it just symbolizes how sustainability or ESG, sustainability more from a corporate lens and ESG more from an investing lens or a investment lens is there on the horizon. It's like for investment firms like us, of course, the point which I made, we raise capital, so the primary responsibility for us is to generate superior returns. But while we generate those returns for our investor, how do we find a balance that we invest in companies which doesn't impact negatively on environment or our planet, similarly doesn't impact negatively to the people, which is in form of communities which represents customers to whom the companies serve, as well as employees of the companies and different vendors through which the people engagement takes place. So it's a similar conundrum for normal corporates as well. For normal companies or a listed firm as well, the same image would reflect or would resonate to their today's context in terms of trying to find a right balance. Uh, now, as a ecosystem or investment ecosystem, there are different kind of players in market. So I represent a private equity which comes into, let's say, late stage when we identify companies which are having decent level of growth, decent level of revenues, but then there are also early stage investors like a VC, right? So from a venture capital organization also, ESG is becoming relevant, PE as well. And then once a portfolio company or an investee company is getting out of a PE ecosystem, the natural progression for those kind of companies is a very large strategic investor would come in and hold that particular investment, or the company may move into the journey of getting listed as part of stock exchanges. So the role of private equity plus other ecosystem players are critical in terms of the whole PVC ecosystem where a portfolio company becomes part of. They are able to understand, of course, how the business needs to be run, what kind of strategies needs to be played out. But while you do that, how do you also look at things like environment and social as compared to what are the expectations from global investors' point of view, so that as and when they move into the hands of a large investor, a global investor, or they move to a listed market or public market, we know that from a SEBI point of view, there are several requirements, right? So again, this is the context which I wanted to set through this particular image. So now there was a recent survey which was ran by KPMG, and it tried it, so it interacted with almost 250 investors globally, and I'm just trying to capture this through initial two slides. The way to read this slide is the KPMG team went and asked different investors, and like the first question, let me just start using a pointer. Yeah. So the first question or consideration which was there as part of the survey was, are ESG consideration currently on the M&A agenda or as part of a merger and acquisition? Are ESG consideration are there as key consideration or no? In terms of responses, what was collated, the one over here on the left, it summarizes, and the way to read this is, of course, the output are presented in terms of different geographies. So you have Europe, Middle East, and America as the first bucket. The second one is Asia Pacific. Third is Americas or North America, and of course, global is the overall perspective. So if you look at the response here, I'll talk more from Asia Pacific perspective where we are. So almost 79% of respondents said yes. So whenever, let's say, a large corporate was trying to acquire any competition or a smaller firm, they have said yes, that ESG is one of the considerations for them. Similarly, if a PE company is trying to acquire a business or acquire equity into a business, then Asia Pacific level almost 80% have said yes. And then globally, if you see, 82% of the respondent have said yes, that ESG is there among the top consideration. Similarly, the second key question which was asked was, why have the ESG due diligence been done as part of their past transactions? So there are various drivers which have got discussed, like few of them which I'll just run past, like the first one being that they believed in monetary value. So lot of bulk of the investors who responded said that they believe that if ESG due diligence was run, they were able to bring down lot of risk, or eliminate lot of risk which can have an impact to this monetary value of their investment. Similarly, uh, they also said that if ESG diligence would tell in terms of how capable was this target company in its ability to respond to regulatory changes. So we know that there are a lot of new requirements which are coming up from Indian market also. If you see, the carbon market is coming in. Similarly, there are a lot of requirements in terms of EPR, which is with respect to plastic rules. So if you do a diligence, you will get to know what is the preparedness of that particular target company to respond to any new regulation or any future regulations to come. Similarly, there is also a key thing, like if it is multiple, then our own corporate policy or requirement insists us that a, ESG diligence has to be done. So here again, if you look at from a global perspective, then almost 56% said that they believe that ESG due diligence was one of the reasons for them to ascertain that the monetary value or the investment of theirs would be intact. Similarly, there are cases where, okay, from a global standpoint, if you see, 33% said that investor is asking them. So, uh, just to explain this context, as I told you, we raise capital from large investors. So, in multiples, we have investment from organizations like IFC, World Bank, ADB. Now, those set of investors require us to run a ESG due diligence. So that way, if you see, almost 33% said that a typical investor who is there on board of that, uh, let's say a private equity firm or a VC firm, or it could be a limited partner organization. Those investors are also influencing why ESG diligence needs to be done. In certain cases, there are lenders who also ask, so the debt providers also insist for a ESG diligence to be done. So the way to do this, of course, if there are questions when I run past the presentation, you could start putting the questions on the chat box, and then we will take most of the questions at the end of session. Just to continue on the survey, the second slide just summarizes one of the key questions, like how well connected is the pre-signing ESG due diligence approach to a ESG strategy. What does pre-signing mean? So if hypothetically, if I am as a multiple trying to acquire a company, or acquire equity into a company, we will have to sign a formal agreement. Now, uh, what are the things which you look at that stage, and then how does it entail to your whole approach on ESG strategy? And here again, the output has been presented for different geographies. So if we look at from a Asia Pacific level, now on this particular chart, there are two viewpoints which have got summarized. One is a financial investor, and second is a corporate investor. So financial investor could be someone like us as multiples, or maybe a bank, or any other global investment firm, whereas a corporate investor would be hypothetically, let's say, Tata companies trying to acquire equity into a smaller firm, right? So that is a corporate investor. So this particular output just tries to show you what is the lens of ESG diligence which is done pre-signing, and how it is getting aligned to the ESG strategy. So from a Asia Pacific level, if you see, from if a financial institution or an investor is looking at a ESG diligence, then they say that almost 64% has a strong or direct linkage of ESG diligence to their ESG strategy. But when it is a corporate, so if it is a firm like Tata or any JSW or Reliance, then that alignment or requirement would be just to an extent of 25%. What it means is, if there is a financial institute or a ecosystem player trying to do an acquisition, there is a far higher chances that the ESG due diligence would be done, and it will be in line with their direct linkage to ESG strategy of theirs. Let's move to the next one. The next question is about, to what extent uh, are the findings of ESG due diligence relevant to your value creation plan of your investment? What does this mean? So when you run a ESG due diligence, it will talk about, okay, there are, these are the gaps, these are the risks, these are the areas which needs to be improved. And then post investment, or what is known as a holding period, you try to create a value creation plan where you work with the investee company. So here again, if you see from Asia Pacific level, things like, they have said that we focus on risk identified in ESG due to due diligence to help us, our investee or a portfolio company, mitigate or preserve the value of investment, which has been said by almost 74% when a financial institution investor is there, and similarly 66% when a corporate investor is there. Similarly, the next one is, ESG due diligence findings are irrelevant in our plans on enhancing the value. So here it is very less. So what does it mean? That everybody as a financial institution, investor is looking at ESG due diligence very closely as part of their investment. Now, what are the benefits? What are the multiple benefits one derives when you start looking at ESG closely as part of your investment strategy? The first bucket is all about creating and retaining value. What it means is, every organization has its own value, and if it is a listed firm, it can be in form of market cap, and if it is unlisted firm, we know at what valuation this company is at currently, right? So, if you're incorporating ESG as part of investing, then the first one is, of course, the consumers of today are willing to pay slightly higher premium to any product or service which has ESG consideration, or which has ESG as part of their business model, or as well as integrated as part of their product and services. Similarly, ESG focused companies outperform other companies. So if I as multiple is trying to acquire maybe a consumer company, and there are two options for me to look at. Of course, a company which looks at environment closely, is compliant to law, has various value creation and innovation as part of their day-to-day business, will outperform another option which I may have to invest into, which is not aligned to a ESG practices. So that ways it helps in creating and retaining value over long time. Similarly, the next one is, it makes financing easier. So uh, what are LPs? LPs are nothing but limited partners. So let's say I am as multiple a private equity, I would be called as a general partner, and LP would be somebody who is invested into multiples or multiples funds. So an good example would be a IFC or a ADB, from whom we would have raised our capital. They are known as an LP or limited partner. So when these large institutional investors want to come and invest in Indian market, they will look at, okay, what are these funds? Are these funds looking at ESG as part of their investment strategy or not? If yes, then it is very easy to raise, or it becomes easy. It's not where it cannot be like very easy, but it becomes slightly easier to raise capital if you are having responsible investment as part of your investment strategy. Similarly, debt financing is again increasingly easier to obtain for a ESG focused fund. So let's say if we invested into IT company a few months back, where we also wanted to leverage through debt financing. So there again, we being a signatory to PRI, we being a fund which looks at ESG very closely, a global bank, someone like an HSBC or any other bank would be more comfortable to come into the deal because of the way in which we look at ESG very closely. And of course, that overall it helps in reducing the cost of capital for companies. And then the next one, which is all about, it also helps in mitigating business risk, right? So it helps in meeting expectation of stakeholders, which helps in brand reputation. It helps in new market creation. Likewise, regulators who are also coming out with different regulations, those kind of risks also you can overcome if your business is ready to respond to any challenge or any change which is going to come into the policy from a ESG lens. I'm going to skip this slide, but yeah, on this one, so what are the various ways in which a investment firm looks at ESG? So there are broadly three ways. Like the first bucket, if you see, which is known as agnostic investing. What does agnostic investing mean? Agnostic investment investing is a ad hoc or a traditional way of making investment. In this particular approach, there is no serious consideration of ESG when a company looks at a particular deal. Okay, they will not do a thorough diligence. They will just look at requirements which are meeting a bare minimum in terms of compliances to an environment regulation or labor practices, all of it. So this is something which is an agnostic investing where you don't have any serious consideration of ESG. The second bucket is about sustainable investing. uh, what it means here is, you are an investment firm. You are looking at sustainability more from a risk minimization lens. So uh, let's say if I'm looking at a automobile business or a mobility business, and I want to take an investment into a firm, I will just see whether the technology in which this particular automobile company is playing, is it a technology which will become redundant from any environment regulation or no. So I'll just look at my downside risk, and I will just try to protect that more from a risk minimization lens. And then here you would do diligence, and then the way in which ESG will be managed here will be largely from a internal firm lens. So you will have certain KPIs which you will track, and you will do disclosure around those KPIs as part of this second approach, which is sustainable investing. Then you have the higher pedigree kind of investing model, which are known as impact investing. For this particular approach, the business in which the portfolio company is, or the product or service this portfolio company or target company would be having, the key consideration is all about how much positive impact on environment, society, or community the product and service of these portfolio companies are making. That is the key consideration for investment as part of the impact investing lens. And here there is like a clear positive ESG criteria or consideration which have been looked at uh, in terms of matrix or in terms of KPIs, which also you look at. So of course, returns is one of the KPI which will be looked at time of investing. But okay, through this investment, am I let's say addressing a particular issue which the society is facing, so something called as financial inclusion. So am I able to reach to bottom of pyramid, and they are able to get different kind of product in terms of insurance or in terms of loan through a particular company where I would look at. So the consideration here is more about impact, when we call as impact investing as a third stage. Now, if you look at again historically, if there is a deal which has a target company or a portfolio company which is into a business like energy or natural resource, there the ESG motivation and consciousness would be slightly higher. Why? Because these kind of companies are there in terms of through the nature of business, they would have some in some way uh, mining or extraction which is linked, or it's there as part of the value chain. And of course we know that those kind of sectors, the regulatory requirement are way higher in terms of environment, kind of environment approvals which needs to be there. In terms of environment management plans, these kind of companies need to have. Similarly, these are the kind of businesses where which are also labor intensive. So there are intense uh, labor norms and practices which these kind of companies need to follow. So when you look at a, a investment which is there into energy or a business which is catering to natural resources, there the ESG motivation and consciousness is very high. So here, if you see, if it is an energy or natural resource kind of opportunity which I look at, almost like 75% of consideration is there on ESG, whereas maybe 25% chances there will not be consideration of ESG. But when you look at holistically in terms of all kind of sectors, if you try to average out, there if you see maybe about 50% of the deals ESG consideration may not be there. And this I'm talking more of a broad market perspective. And then about 47% of the deals ESG consideration would be there. What does it mean? Of course, is if there are businesses which are negatively impacting environment or labor, those are the investments or opportunities where ESG consideration has to be way higher. Now, what are the different frameworks which are available for when you integrate ESG as part of your investments? What are the different frameworks globally which are available? The first one is principle, something called as principle of responsible investment. It was an initiative launched by UN, and you would have come across PRI in a lot of your earlier presentation or discussions as well. Now, when the discussions around climate were happening through Kyoto Protocol, then of course related discussion happening through Montreal Protocol and all, UN parallelly also wanted the financial ecosystem to start looking at the environment and social consideration. That's why UN had initiated this organization which is known as Principle for Responsible Investment. They they are again a not-for-profit, a think tank, which is guiding the whole uh, gamut of companies who are there in this financial ecosystem. So, be it large banks, publicly listed firm, unlisted firm, private equity organization like us, financial services firm which provide solutions around private debt, debt securitization, bonds, all of it. So, this is again a body which tries to influence the ESG consideration by the gamut of companies which I spoke on. So, and then PRI has developed some. So, PRI is something which is a principle based approach of integrating responsible investment strategy. So, there are six principles which have been laid out by PRI, and largely companies who are signatory to the PRI will have to fulfill the requirements around those six principles. The second standard, again, lot of you would be aware. So IFC, which is International Finance Corporation, or it's the investment arm of World Bank, they came up with their own performance standard. These are about six performance standard. It's available on their website. So you have PS1 to PS6. Now these are again uh, like a performance standard in each area which IFC came up with. So There are performance standard on environment, health and safety, performance standard on biodiversity. So if there is a company which has high exposure to any protected area or any eco-sensitive zone, then that performance standard on biodiversity conservation gets triggered. Similarly, if there are cases where a large factory has to set up and there is a land acquisition, then there is a performance standard which looks at how has that land parcel got acquired. Is it by force or is it by providing a proper compensation? So again, those performance standards have been defined by IFC in a way that it helps a company to meet global requirements or global good practices of investment and execution around investment. Similar to IFC, ADB, which is Asian Development Bank, they came up with their safeguard policy. So here again, both IFC and ADB, they have certain exclusion list or exclusion criteria. Okay, these are the kind of sectors or businesses in which we will not invest. So examples are like direct exposure to fossil fuel, which is coal or oil, you can't invest. Similarly, if you have a business which is related to tobacco, gambling, you can't invest. Similarly, a business which is into uh, defense or active defense or warfare, those kind of investments. So both of this IFC and ADB has certain exclusion criteria which help you just remove a lot of industries which are not ESG aligned. The next one is IFRS. IFRS, of course, has the ISSB standard. So you have IFRS S1, S2. But yes, SASB or Sustainability Accounting Standards Board, which was again earlier North America based, but now acquired by IFRS Foundation. SASB has been used by a lot of investors, global investors, and specifically North America based investors. What SASB provides is for different kind of industries they have given, okay, these are the kind of material issues which any investor needs to look at. So they have given sectoral materiality and what are the kind of data which needs to be tracked or which needs to be tracked by the company as well as investors when they are looking at this kind of investment. The next one is operating principle for impact management. So as I told you, there are firms like us, like as multiples, we are not an impact investor. We focus more on ESG, and of course, through that, whatever impact we can drive, we do. But then there are dedicated impact focused funds or firms. For them, this kind of frameworks like OPIM is relevant. It helps them put systems around their whole business model so that they're able to measure the outcomes of what kind of impact they have been able to derive by that investment. So this is again a principle based standard which is available for any impact focused fund. And then, of course, lastly, the UN Sustainable Development Goals again could be used by a lot of investing firms to look at what kind of areas they touch upon from environment, social partnership, and all. And then they can just align their initiatives, what kind of outcomes they're able to derive, again, map to a particular sustainable development goal. So these are the different frameworks for consideration for any private market organization. Now, the next part of the presentation, I'll delve into how we as multiples have been able to integrate ESG over our investment cycle. So the starting point, of course, I have not captured here, but the starting point for us is we follow the exclusion criteria. So our ESMS framework or environment social management systems or that framework for us, we also have a list of exclusion criteria which is been used to do screening for any. So the business, the way in which the business runs for us is, of course, we have an investment team which looks at different deals. Now, once the deal comes, they will apply the screening criteria and then say that, okay, these are the kind of sectors in which this potential company is not operating. So we could look at this particular. So you screen that investment. After the initial screening, we will have to do this kind of categorization. So if you know, or if the way in which we have defined our categorization are very similar to how, let's say, Ministry of Environment and Forest would have defined when you want to get some kind of approval like an environment clearance or EIA, right? So the broad categorization what we have done, the first one is category A, or a business which has very high impact on society, people, or environment. So category A would have cases like if there is an involuntary settlement. So example is if somebody is building a dam, then of course you need to move a lot of people out. A lot of villages will have to be displaced. So that can be a category A kind of project. Similarly, that same project can have a project or a company which has that kind of high impact on environment uh, and people will get categorized as category A or high, or categorized at high in our case. The second one is category B, which has limited impact. So it will not have case like you will have to displace a lot of people, or it will have very massive manufacturing plants like maybe a coal mining or maybe an oil refinery. Those all those coal mining or oil refinery, those kind of investment would fall into category A. Category B would be a lot of uh, like a consumer kind of business. So maybe someone is who is into apparel manufacturing, or someone who is into maybe uh, luggage manufacturing, or someone who is into EMS kind of sector. Those kind of investment would fall under category B or medium. And of course, category C or low would be sectors which have very low impact on environment. When I say low impact, I mean low negative impact. So businesses like financial services or NBFCs would fall here. Businesses into technology would fall. So this is the first, second step for us. So we will categorize all of any potential deal into these categories. And how this impacts is, if it is a category A project, then we have to do a very thorough diligence where you do the diligence in a way that you have to do 3 season survey, uh, and then spend a lot of time as part of ESG diligence, as compared to maybe if it is category B, then the ESG diligence is not that intense. And category C can be a case where your own internal team, so maybe our own internal team can also look at the bare minimum compliances around environment, social, and look at the process and do come up with our own way of looking at the ESG risk for the business. So this is the way in which we would categorize any of our new investment. Now, there are three stages for any PE investor, or it is similar for a VC investor also. The first stage is pre-investment, which is I have got an opportunity. My deal team has looked at a company. Before I do any legal contract and say that, oh, I have committed this much investment into a business, that is a stage which is known as pre-investment. So, what are the things which we do? I spoke about this. So, at the pre-investment stage, the first thing which we look at is exclusion check. So, we'll see as per the industries or a prohibited investment which is there as per my policy, is this new company or opportunity which I'm looking at, does it fall under that exclusion criteria or no? The second one I've just explained you in the earlier slide. We do the risk classification, whether this is high, medium, or low kind of investment. And as multiples or as a firm, we largely invest into only into category B or category C, which is into medium and low risk. Depending on the risk, classification, we'll do the ESG due diligence. Uh, and then the intensity of due diligence will depend whether it is category B or category C. Category B would be more elaborate. where you have to interact with a lot of people at the target company community around that. And if it is category C, then it will not be that intense. Once we have done all of this, the next stage just before investment would be getting an IC approval. So IC is known as investment committee. So like a large company which will have a board. Similarly, for an investment firm, there you will have IC committee which would look at uh, all the inputs. As in ESG is one of the input. Of course, the deal team will give commercial inputs with respect to commercial decision. All of this will be synthesized and an IC approval is sought. And IC says go ahead. That's when we get into the investment phase. What happens into the investment phase? You get into the legal documentation. So you prepare what has to be written into my agreements, which the target company would sign. So let's say I'm taking 10% equity and I'm paying 100 crores against that. What are the things which the portfolio company or the target company will have to follow? All those things get captured as part of legal documentation, where the ESG related requirements are also been put out. So we will say that okay, these are the bare minimum data points which you need to track. You need to form a ESG board level ESG committee which will do a minimum of two reviews on ESG during our investment phase. These are the kind of policies on ESG which they will have to develop. And then what diligence also tells us, okay, what is a gap against the expectations on environment and social, which we as multiples need for each of the target company. So that gap has to be addressed, and that can be addressed through something called as environment and social action plan or ESAP. This is again a common term which you will hear in this kind of business, where as part of the agreement you will write down, okay, these are the 10 things which this company has to do in this time frame, and then that will get monitored as part of our investment period. Post investment is, as I told you, the monitoring of ESAP would take place. So generally we do monitoring every quarter. Uh, and then closing on ESAP is like a easier task, which helps us minimize the risk or eliminate risk. But as I was telling you, as multiples, we focus more also on value creation. So we are not wanting to just eliminate risk. We want to see that our work helps in uh, adoption of best practices or good practices by this target company, so that whenever we exit there is an ample amount of value creation opportunity which takes place because of the work which we do with the portfolio company. So these are the three distinct phase, or you can say as life cycle of investment, which is pre-investment, actual investment, and post investment, which is by the time we exit. So typically the post investment phase is about anywhere between 5 to 7 years. So as a PE company, we will be invested into any company for minimum of 5 years. Now there is ESG policy of multiples. It's available on our website. If somebody wants to have a look, can go through that policy. It's available, as in the entire policy is available on website. So in terms of key components of that policy, of course, applicability is there. So what are the kind of things which any portfolio company will have to fulfill is they will have to adhere to the national and international laws on environment and social aspects. They will also have to adhere to IFC performance standard, ADB or NIF. Now, this depends on which fund of ours. So P normally what happens is you will have different funds and investments are made through different funds. So in our fund three, we have IFC, ADB and NIF. So these are the three investors which are there as part of our fund three. But the new fund, which is fund four, there only IFC is there. So if I am investing through fund three, all of these three becomes applicable. But if I am investing through fund four, only IFC performance standard and multiple requirements are applicable to that particular company. And then, of course, this I've explained. So pre and post investment monitoring. So you do screening, risk categorization, due diligence, legal documentation, and then there is an annual reporting also which needs to be done. You need to collect data from portfolio company and then do this disclosure or reporting to LPAC, which is nothing but Limited Partners Advisory Committee, which is the investors who are there on our board. Now, as part of ESG diligence, what are the things which you typically do? So, if I have to do a diligence, the starting point would be to prepare a information checklist. So, I will have to look at various things with respect to compliance, with respect to policy, with respect to process, with respect to uh, monitoring and review mechanisms, which is there into the which is been practiced at the company. So what I would do as a first step is I will create that information checklist and share it with the target company or portfolio company. So for us to get their information, basis which the next step would be to do site visit. So uh, maybe I'll give an example. We invested into a commercial electric vehicle company of Murugappa Group, which is Montra Electric. This company is there into EV manufacturing of or three-wheelers or auto rickshaws. They are into EV truck manufacturing and EV tractor manufacturing. So they had three different sites, and there is also a corporate office. So as part of site visit, as part of ESG diligence, we will go and first thing is we share the information checklist for corporate and these three sites. We will go and do actual visits to the corporate. So we'll do meetings at corporate office, and then we will do site visits on all these three locations. Look at all the approvals. Look at lot of documentations on each of these area, which I'll try to also take up through subsequent slides. So as part of site visit, we'll go to the actual site, we'll do management meetings and discussions. And once we have done this, the next thing what we get is gap assessment. We know that, okay, this particular company, the consent to operate uh, has certain issues, or let's say the reporting which they have to do the various pollution control board are not done in certain timeline, or they don't have any grievance mechanism in place, or they have not identified their stakeholders. So there are various things which will get captured as part of this site visit, which gets converted into the action plan. So as part of the diligence, the key output would be the ESAP, which comes out, overall ESG report, which will get prepared, and then uh, based on the ESAP and ESG, the ENS note or environment and social note, which will be going to the IC presentation. Post So engagement with company uh, is, of course, you through our investment we try to identify or we ask companies to hire a dedicated ESG manager who can look at all of these things. There is a periodic monitoring. Every quarter we review the ESAP, and then annually annual ENS report needs to be prepared by the portfolio company and shared it with us. uh, Something which we again very closely do is that if there are any serious incidents, so if there is any fatality, if there is a fire, if there is any emergency and because of which business disruption have taken place, then this kind of serious incidents needs to be reported to us by these companies in 24 hours. So within 24 hours they will have to do this reporting, and within 72 hours we need a detailed report from their side. Plus, we also have our own environment and social MIS, which we collect every quarter from our portfolio companies. And then after engagement with portfolio company, we have to do reporting as I was telling you. So serious incident like they report, portfolio companies report to us, we in turn have to report to the limited partners or basically our investors. And then every year we have to do reporting on our ESG practices to these investors. And we also try to do annual training sessions on environment and social issues. Now, what are the key things which we as investors would look at as part of ESG diligence? I've tried bucketing this into the three buckets, which is environment, social, and governance. Now, when we look at an opportunity, and I was staying back with that same EV manufacturing opportunity, when we would have looked at that business, what we would have first looked at is how exposed is this company to ecological aspects. So, uh, is any of the factory of this target company next to a national park or to a wetland? If it is yes, then we know that okay, this is something which we need to look at very closely as part of ESG diligence. The next thing is okay, they are operating three factories. They will need lot of things. So they will need a consent to operate. They will need a consent to basically they'll need a consent to establish first before setting up a plant. They will need a consent to operate before doing the commercial production. If it is a large operation, then maybe an environment approval or environment clearance or Ministry of Environment and Forest would be required. And then there will be, if the this particular company didn't have anything with respect to e-waste, plastic waste, but let's say they are into EV manufacturing, so battery waste, which is categorized as hazardous waste. Again, do they have hazardous waste authorization or no? So these are the things which we will have to consider when we are preparing or we are conducting an ESG diligence. Similarly, there are factories in the corporate office, they will have offices. So whether how stable are those buildings, and then whether there are some banned items being used, like and do they still use asbestos sheet or no, or do they have some exposure to lead? So all of those things which will also be looked at. Then, from an ecological point of view, CO2 emissions. Now, climate change or CO2 is critical. So, this particular business was into electric vehicle manufacturing. So, naturally, the product is not having anything to do with fossil fuel consumption. But as part of actual manufacturing, we will have to look at do they consume fossil fuel in form of coal, or oil or no, and then those things will have to be looked at. Similarly, what are the kind of waste which is getting generated, and then do what are the kind of rules and regulation they will have to follow from a waste point of view, and also from a water point of view. So our experience says that there are some gaps which we observe on the environmental requirements or the compliance perspective. There are a lot of gaps which you observe on waste and water. So energy and environment, still there is a lot of things which companies are able to cover up, or they have certain way to address and manage those issues. But waste and water is like a neglected area. So a lot of companies, they don't possess a valid waste authorization. Similarly, they don't have tie-ups with authorized waste recyclers. In terms of water, we have observed that a lot of times companies don't have, if they are drawing water from ground, then they may not have valid approval to abstract groundwater. So those are the things which we will have to look at when we do the ESG diligence from environment point of view. Similarly, from a social diligence point of view, the biggest stakeholder which I spoke was employees. So, how satisfied are the employees? So, we will look at HR policies around HR. So, uh, what are the kind of leaves which are being provided? What are the kind of trainings? What are the kind of development opportunities the organization uh, is providing? Similarly, uh, what are the kind of working hours? What are the kind of things around forced labor, or what are the kind of policies they have around employees is what we will check. Innovation culture, this is more from a value creation lens. So how innovative is the company in terms of addre- coping up with any new challenge. We know that the world is very dynamic. There are newer challenges which keeps on coming, like uh, There are supply chain disruption. How is the business able to respond to that disruption? So we'll and then whether that culture of the organization is also there at the people level or no. The next one within social is of course customer. So we will look at how how what kind of practices the company has. Are they dealing with customers with fairly or no? There are a lot of business, like we invest in business which are also into financial services or fintech. So how is the whole data privacy of customers being dealt by this portfolio company? So we will look at all of these things as part of social. Data breaches, I spoke. So cyber security is one of the key requirement. And then lastly, if there is a physical product, then what are the kind of compliances specific to the product are required and are the companies having? Similarly, do they have manuals which tell the end customer how to use this product? What are the, if there are any safety risks, then are they providing that information to customer or no? So all those things will be covered as part of social diligence. And lastly, governance. Of course, we will look at how well governed is this company. So what is the board composition? What are the expertise available with each board member? Then what is the quality of management? So whether the senior leadership is experienced enough to deal with any of the environment and social issues, if there are any foreseen environment and social issues in this case. Then in governance, of course, you also look at, do they have policies around bribery and corruption? Do they have systems to deal with those any situations if which may come up? We look at independence of board. We also look at reputation risk management and also anti-competitive behavior. So these are the things which gets considered and looked at as part of diligence. So these are basically the nothing but key considerations when we start doing or when we are doing an ESG diligence. Now a typical spoke in my earlier slide also I have tried taking up uh, how a ESG diligence would be done. So Uh, the first thing is, of course, the IRL or information checklist would go to the company. Now, the IRL will try to fetch a lot of things which are been displayed on this slide. Okay. So, under the environment part, you look at the history of a site. So, if it is again that same electric vehicle manufacturing opportunity, if we go back to that example, then I will look at what is the history of that particular manufacturing site. Whether this, what was the land use of this site before the plant was set up. Okay, so I'll try to look at the historical land use. I'll also look at the current processes the company is running and whether any, so whether that could be any historical damage of land contamination. Similarly, the current operation also, can there be situations where a land contamination issues can come up uh, by any adjacent land owner? So those are the things which I look at from the site perspective. I'll also look at the again basically land use, which is land register. Then any environmentally relevant claims or environmental crimes which have got attached to that particular land, that also needs to be looked at. So there again, as part of diligence, we'll look at the land records of any open issues attached to that particular land parcel or no. It becomes absolutely critical because we have seen that any historical issue can also come and can be an issue and it can result into maybe a situation where a compensation will have to be paid and that becomes a outflow to a business. Then we will look at the uh, pollution related data. So we'll collect data with respect to air emission. So if there are DGs at operation, we'll look at those records. If there are power plants, again we'll look at fuel consumption, then air emission reports. Similarly, what are the kind of water treatment as well as wastewater generation and management related records. So we'll try to corroborate based on production level, whatever numbers of wastewater or waste generation they are providing. Are they commensurate to the level of production or no? Or are they giving some misinformation to us? So we'll do that kind of analysis as part of the environment piece. So this are the kind of documents also which we'll ask. We'll go to the site, we will validate those documents, and basis this will come up with the findings. As part of social, we will look at customer satisfaction analysis. So companies normally run externally customer satisfaction surveys. So there are things like net promoter score or customer satisfaction survey or CSS. So there are various ways in which a company can assess whether what is the level of satisfaction of consumers by that particular. So we will look at those reports, presentation made to the board or senior management, which helps us tell what are the practices which are there from a consumer or customer protection lens. Similarly, uh, we'll look at the data protection and privacy policies from a HR lens. Do they have diverse and equal opportunities or no? So whether they treat female as part of workforce as equal or no. So we will look at whether they have a diversity policy or no. Similarly, equal opportunity is all about, do they also take people from differently able community or no, whether that kind of equal opportunity is being provided or no. Then the employee attraction, here you look at again what are the kind of employee engagement practices they have, what are the kind of trainings being provided, what are the kind of benefits which are being provided by company. So you meet the HR, you look at different records and try to establish whether these are industry good practices or no. Then uh, corporates and employee social commitments. So here again, if a company is bound to do any CSR expenditure, are they doing or no? Similarly, corporate and community, government and community relations. Then we also have to do examination of compliance with human rights. So there may be a business where a lot of contract labor is there. So here again, are they being compensated to any overtime issues or no? So we'll have to look at salary slips, we'll have to reconcile it with the bank statements, and then establish that yes, there was a overtime issue and that was paid. If not, then all of this we will ask the company to pay before we can go ahead and invest into that business. So these are the again kind of things, supply chain or sustainable supply chain or product safety. So again, we will have to look at a lot of documents with respect to product safety and liabilities. We'll also look at if there are, so through the legal and compliance team, we'll try to check if there are any ongoing product liability related issues or no. So all of this will get as part of social aspect of ESG diligence. And then lastly, governance. We'll look at the legal register. We'll look at code of conduct, compliance of code of conduct of all employees to code of conduct or no. Then we look at again, every company would have oversight committee on bribery and corruption. Similarly, that same committee would be looking at any anti-competitive behavior or no. So those are the, again records which we'll check as part of governance. So these are basically the approaches which have been used by a private market player when we will do a thorough diligence. Now, what are the kind of challenges which anybody would come across? So, uh, the first issue which comes up is uh, selecting a meaningful or manageable scope. So what happens is we will start a diligence. We'll say, okay, we are going to come and visit all your three manufacturing locations with that same example and corporate office. Then there are a lot of give and take. They may say, okay, let's just do two site visits or two visits, and the third one you can do a desktop review. So, and in this process, what happens is you have a portfolio company, you have multiples as an investor. In a lot of cases, you also have a banker who is playing that role of facilitating that transaction. So there is always a challenge in terms of coming to a manageable scope between these three entities. So that is one of the key challenge what one faces when you are doing a investment. The second one is difficulty or difficult to quantify potential findings. Now, here again, it is a matter of understanding. The company may say, I already have XYZ things, whereas an investor like us, based on our diligence, would say, no, you don't have just these three, but you also have like three more things which is not present, which we have observed as part of diligence. So there is always again a discussion, and lot of cases there are disagreement in terms of, okay, this is the kind of potential findings, and then you have to do a lot of calls between the investor, banker, and portfolio company to eventually come to a conclusion. Okay, these are the 10 things which you will do, which you have identified as part of our ESG diligence. The next one is lack of robust data or written policy. So uh, typically, again, ESG or ESG integration in investment ecosystem is like early days. This whole process, from a corporate point of view, in India, things have been happening for more than 20 years now. But from a investing world, it's only about last 7 to 10 years when there is been action around it. So what happens, and then as a PE you invest into unlisted firms. So listed firms may have investor grade data or data which is more reliable, but unlisted firm there is a lack or shortage of robust data or data management system. The next one is lack of common understanding of what ESG diligence means. This I think I've addressed in the second particular point, but yeah, it's always a case where there are three entities involved. The level of understanding and expectation would be different. So that is another challenge which is being faced in any diligence process. Then the next is don't know how to approach ESG diligence. So a banker or a target company or a portfolio company will say we have never experienced this. So there are a lot of cases when companies are doing fundraise also for the first time, so they have not got exposed to an exhaustive diligence exercise like this. So the common feedback what we get is we don't know, so why can't we avoid this whole process? So that is again a challenge which we face. The next one is issues identified from ESG diligence are not calibrated against investment materiality. What it means is there are a lot of points which will come up as part of diligence. The banker or a portfolio company may say that okay, there are certain things which has no financial materiality. Then why do you want to keep it? But uh, we try to keep all kind of issues on the table when when we are doing negotiation, because what we believe is direct financial materiality. There are a lot of things which beyond that also. So things like, okay, you we ask companies, are you doing training on ESG or no? There it is very difficult to prove that it has a direct correlation to the investment materiality. But we still stick around or we still ask the companies to agree to it because we believe it helps in creating culture and eventually helps in value creation through ESG. The next one is difficult to find benchmarks. So they will ask, okay, where has this kind of observations come? Have you come across similar observations in any other deal which is in the same sector? What are the kind of actions you have asked? So there again, getting a difficulty in terms of comparable benchmarks or peer benchmarking. The The next one is not difficult to find a knowledgeable advisor. So the consultants and then consultants capability to handle diligence as well as work post diligence, that again all lot of portfolio companies find or they struggle to get a right kind of advisors to work with them. Then low level of knowledge training or common terminology, this is similar. Encountered no serious challenges, like if you do diligence and you come up with the stage of the ESAP or diligence finding, the common thing which they will say, okay, there was no serious challenge. Now, why do you want to get all of these terms included as part of this? That is way, another way of getting the whole challenge framed by portfolio companies. So these are like the common challenges which one will face when you are doing ESG diligence as part of investment. We are at 4:15. Maybe I'll just take 10 more minutes to finish the balance slide and then we can take up questions. Quickly, which are the kind of external advisor which are there in market? Big Fours are the biggest constituency of uh, service providers to ESG diligence. There are a lot of specific ESG consultants as well. So there are boutique consulting firm who do a lot of work on ESG diligence. There are inspection or certification institutions. So there are firms like SGS or BBC, which are certification bodies. They also do ESG diligence. Then you have engineering and technology firms. So examples are AECOM is a good example, which is more of a real estate technical company, but they do ESG diligence as well. Nowadays, law firms have also started doing diligence. So this is a breadth of consultants or advisors which are available in market. Now, from multiples point of view, as I was telling you, diligence just helps us in protecting value for our investment. But as a firm, we follow this three-tier approach: tier one, tier two, tier three. Tier one is basically the risk minimization or value protection. So we will ask companies to adopt ESG policies. Will ask companies to develop an ESMS document. ESAP is nothing but the gaps which have got identified as part of diligence. And then we'll also ask companies to hire dedicated resource on ESG. So this is the bare minimum or the first tier of engagement for us. The second one is we are investors into five broad sectors. So we are invested into financial services, technology, consumer, and pharma and healthcare. These are the sectors in which we invest. Now, based on experience, what we have observed is these are the four common areas which is applicable to any of our portfolio companies. So we will do this second tier of engagement. We call this as horizontal themes, which are into diversity, safety. We ask companies to move towards renewable energy, and then of course we have our own model of doing ESG KPI based ESG maturity. So this is something which we work across all the portfolio companies of ours. And the third tier is like a vertical theme, which is very specific need for a particular company. So there may be a company where we need to do hand holding on biodiversity. There may be a company where we need to do just materiality assessment, or there may be a company where we do sustainable finance. So this third tier is helping us do value creation kind of projects with our portfolio companies. ESG maturity model, the ESG KPIs which I spoke on. So we have developed about 45 plus indicators or KPI which we track for our portfolio companies, which are into ESG. Broadly, the themes which we are covering under environment is renewable energy. We ask companies to do GHG inventorization. We track circularity more from how do they handle waste, and biodiversity and nature, which we look at more from water recycling, reuse, and tree plantation. On social front, we have things like diversity, inclusion. Safety is a key area for us. Then employee satisfaction and community outreach. In terms of governance, we look at board composition, independence, and supply chain sits under governance for us. How are the company dealing with stakeholder grievance mechanism and customer engagement? So these are the KPIs which we track for each of our companies. Key initiatives, Suraksha, which I spoke. So, safety, health and safety is very critical for us because almost like 60, 70,000 people are employed across our portfolio companies, and these are smaller firms. So, what we have come up with is five-step framework. We call this as Suraksha, which looks at governance and policy. How are they identifying risk and hazard as part of their day-to-day operations? What are the kind of mitigation plan they have? How do they review and monitor and review? And finally, how do they promote culture on safety? So we have like a detailed framework, and we ask each of our company to follow this framework. I'm going to skip this slide, but this is again a well accepted framework or program which we have been running. This is just a snapshot of the first version. We have also moved into the second version of Suraksha. We have also got this accepted at globally by UNPRI. So a case study around this was published by PRI last year. Then climate risk, we have following TCFD framework. And what we have done is to identify the transition and physical risk as part of our portfolio. We have created a simple Excel based tool which our portfolio companies can run. And that tool helps the company see if there is any transition risk which they are going to face, uh, or physical risk. Most of our investment, there is nothing in the transition risk bucket. But in physical risk, there are one or two companies where we see that there is potential long-term physical risk. So these two companies, we are doing more deep dive in doing the physical risk assessment for those companies. Now, I've spoken. So this there, we also run certain center of excellence. So any portfolio company which is going into public markets, we help them come up with their own material, doing their materiality assessment and their sustainability report. So two of our companies have done that in last 2 years. We also work on decarbonizing the operations, and lastly on the ESAP which we run. We do regular trainings for our employees on ESG. That's a regular exercise. We also run a lot of knowledge sharing sessions for our portfolio companies so that they can cross learn from each other. Success stories I'm going to skip. I think I'll take a pause here and we can take up questions. You're on mute, Hina.
Yeah, sure, sir. So we have few questions from our participants.
Yeah.
So our first question is, how can we conduct due diligence for a privately held or a IPO with less or no disclosure?
So, see, even if a firm which is not listed, okay, the one or two slides which I showed, right? There are certain things which you need to look at, or what are the things which you need to look at. So, uh, any company who is running a business have to be compliant to law. Okay, that's the starting point. So we will list, as I was telling or explaining you, we will list out, okay, these are the applicable law or rules which this particular company needs to follow. And now
Correct.
we are in business, we know based on our experience and expertise that all of this law is applicable and they will have to fulfill. So that is the starting point for us. And then if there is a rule and there are certain policies also which a company needs to have, if their policies are there, then they need to have processes to exhibit that they are adopting or they are adhering to the policy. So we will frame our questions basis that, and believe me, even if it is unlisted firm, these are the bare minimum things they will for sure have. So that
Correct.
becomes a starting point. And once you go to the site, you will meet, you will talk, you will do site visit, you will have a lot of observations with respect to safety, because any site you go, you will have issues with respect to maybe workers not following safety norms, they are not using the personal protective equipment,
Right.
right? So it's like you may feel that no unlisted firms may not have so much of information, but believe me, there is a lot of information which you will come across when you start ESG diligence.
Correct. Thank you. So next question is, how do board and management committee oversee the ESG due diligence outcomes?
So this is from multiple lens or from a portfolio company lens. So I'll try to take up both.
Both, yeah.
So as I was telling you in my slide, it we have a IC committee is
Correct.
almost equivalent to board. So if it is a corporate, then you will have a board which will approve. In an investing firm, you will have
Invest.
an
Correct.
investment committee where it is comprised of few yeah, senior officials of the firm, and then there is also independent person because the investors would want somebody as an independent as part of that approving body as well.
Correct.
So after diligence, and then it's not like one meeting, right? So first IC meeting, the committee will look at, okay, we have said these are the exclusion criteria from a ESG point of view. Are we fulfilling or not? That's the starting point they look at. And then subsequently, when we are progressing on diligence, the output of diligence is presented. And uh, just to consider here is just not the IC would not meet only for ESG related
Correct.
discussion. The IC would look at the deal holistically. They will look at a lot of commercial consideration, business consideration. They look at how this investment would pan out because you are invested into, let's say, 5 or 7 years. So they will look at market condition, risk, all of it. And of course, ESG consideration is one of it. So IC will look at all of the requirements and then finally give a go ahead, right? Uh,
So, yeah.
yeah.
Sorry, continue.
And then similarly, what happens is, let's say there is a target company which I am evaluating. I my IC would say, okay, these are the requirements which are bare. So we'll ask, okay, we need a board seat. Okay. Similarly, from ESG point of view, we'll say we need a committee at board level which needs to review ESG at least once in 6 months. These are the like you will have a lot of unlisted firms
Correct.
who may not follow anything from a law point of view. They may say, okay, this consent is not applicable, I'll not get. Okay, so but we'll say, okay, you need this. If you don't get the approvals, we will not invest. Okay, so then their board will also look at, okay, what is the ask of an investor from an investor side. And eventually, if they agree, then our IC would finally approve. Okay, we move ahead, but that is not the end. Okay, because we have large investors, the board of the large investor also need to say yes to it. So once our IC clears it, the IC or investment committee of IFC or similarly, there may be like 10 investors. They also will have to approve the investment, after which the actual agreements would get signed and we would deploy capital.
So, as you rightly said, the investment committee will look at a holistic investment perspective and not just the ESG. So, connecting question is then how do you or basically the IC committee or we as consultants prioritize ESG risk versus financial risk, which we come across during our ESG due diligence?
So the IC note will have everything. It will have the output of something called as FDD or financial due diligence. Similarly, legal team runs a legal due diligence.
Correct.
Compliance and governance run a compliance and governance. Then there is something very specific to a technology diligence. And then you also run a forensic diligence and ESG diligence. So the synthesization of each work stream is presented, and then IC would delve deeper into, okay, which of these are business critical issues. There, if let's say, I'll give an example. Maybe 2 or 3 years back, we were looking at investment into hospital chain, and two of the assets didn't have fire NOC around fire.
Okay.
So all other terms were acceptable from an investment point of view, but the two NOCs which were absent, our IC felt it is not uh, basically it's too
They
much
are
of risk
critical,
to
basically.
carry
Okay.
for us. If the NOC is not there and something goes wrong as part of
Right.
that investment phase, we would not like to take that risk. So if there is a very significant risk from a ESG point of view, that is again delved deep by the IC, and if there is merit, then they would say no to it.
Correct. So you've rightly given this example, but is it usually that a company which shows poor ESG performance but high financial returns, how does a investor deal with such companies?
So again, what we would look at is we will look at the company. We are meeting the management, and if we get a comfort, let's say if there is an opportunity where the financial returns are very high, okay, and then we as an investor we know, okay, there are only certain gaps and we'll be able to address those gaps, which is upfront discussed with the company. And basis that if we are confident that maybe in the first 3 months of our investment we'll be able to address all of it, we take a commitment, then we would be open to take that particular investment as well.
So
But
do
if
you
if it's like a non-compliant thing, then of course we will not say, like the fire example which I gave.
right,
So compliance is the bare minimum, but on top of that, if we find gaps which are addressable in
right,
certain time frame which is of comfort to us, then we would be open to consider it.
yeah. So, sir, how do investors measure long-term benefits of a responsible investment strategy?
Again, there is no correct answer
Yeah.
to this. Mostly, what you will see is intangible. Like, but I think in one of the slide I spoke, one of the slide which I said, okay, see, for somebody who is a foreign investor or large investor, multiples is one of the P firm where they can deploy their fund. There are hundreds of companies in India. Globally, you can say thousands of companies. Uh, and then a lot of data which I showed, not everybody looks at ESG. Now, there are segment of investors who would want to deploy their capital only with firms which are aligned to ESG. So if those, that's a clear business case, okay, of for us. And that we are in terms of vintage, if you know that we are into our fourth fund, like we started 15 years back, we have deployed three funds fully. We are under deployment of our fourth fund. Okay.
Mhm.
Our fundraising team also, when they go and engage with investors, they they get feedback in terms of, okay, we get comfort into coming into you because you exhibit and you are aligned to the responsible investment principles. Those are like the clear benefits
Yeah,
what
benefits.
by which we can measure. Plus, of course, there's a lot of proven research which says that, okay, ESG compliant businesses, like from a portfolio company end, are the businesses which will not be an investment which is, let's say, there won't be any malpractices around governance with those kind of investment. There won't be any non-compliance from environment and social. And then if there is any new future regulation, these are the businesses which would be future ready and will not have any impact on their business in long term.
So, do you personally think that investors should have minimum ESG investments for every investment that they do, or they can allow flexibility based on the context?
This has been asked from
Uh,
again,
General, yeah.
no, I want to know whether it's from a retail point of view or from a organization point of view.
I think you can answer both here also, so that the in like our people who are hearing us, they can have a broad
So from a individual lens, again, it is all dependent on individual's self-belief, right?
belief, right?
So there it is slightly difficult to comment, but of course, At least personally, if you ask me, then at that level also people should follow
Minimum ESG.
yeah, minimum ESG. And then from an Indian market, if you see, still we are not that much ready, but yeah, there are few funds which are focused on ESG based investing only.
Correct.
So maybe at least to about 5 to 10% of allocation you could look at, because historically it has shown that ESG funds or ESG aligned investments have fared well as compared to market returns. Uh, that's one. And then of course, as a large corporate or a large investors, uh, uh, that also, if you have to be a business, basically if you are in a position, or are you in a position to provide commensurate returns to investors, if you have invested into ESG aligned businesses,
Mm,
you can be confident that you'll be able to return back that
correct.
money.
So, sir, what is the biggest gap that you see between what regulators require in the ESG disclosure versus what investors need for their due diligence?
See, when investors look at ESG, one big gap is, of course, investors try to look at more from a global perspective,
Correct.
whereas regulators would look at more from a local
Local
perspective.
perspective.
Okay. Uh, uh, like if you look at, maybe one example is like, why do we, in my presentation I said we focus a lot on suraksha or safety.
Corruption.
Now global investors, they may not focus so much because they are putting money across world, okay, and lot of other market this kind of risk are not that. But as we are multiples here locally trying to do business, we feel that the social issue or safety related issues are very relevant. So that's one gap from a global versus local point of view. uh, what we have observed is, Indian regulators look at things very meticulously. We have looked at opportunities outside India also, and believe me, they don't have those kind of systems, policies what we have here in
Yeah.
India, right? So from that point of view, again, SEBI is a great example of how we have started looking at ESG, right, as part
Mm,
of at least the top 1,000 listed firm, and indirectly to unlisted firms as well. So I think I'll just leave it there.
correct. No, thank you so much. You answered it very well. I have one last question from the uh, our participants, and then I have my two, three questions. So, sir, in what way is the ESG factor that will influence your, maybe you can take your firm as example, a PE firm's investment decision making?
Come again, Hina.
In what ways will ESG factors influence your investment decision making?
So in our case, I think the whole presentation was all about that. So
Yeah.
for us, it's one of the key consideration. So for all of our investments which we have done, it is one of the key consideration. Like another, maybe I'll give one more example where we've invested into a logistics business recently.
Okay.
Logistics as a sector, we know that there are a lot of gaps in terms of labor practice. So the way in which maybe companies would have their drivers. A lot of companies in market may not have right kind of agreements or contracts also with drivers. This
Correct.
particular opportunity also had certain gaps. We made it clear before we come in, you need to bring all the drivers on board. You need to have formal agreements which defines how much are you going to pay them, what are the kind of leaves they will have, what are the kind of working hours they will have, what are the kind of breaks that they need to take, which are aligned to the Motor Vehicle Act. Okay. So uh, what I mean is, we look at this very seriously, and before going into an investment, we'll try to make sure that all of the compliances are in place, and then we start working on things beyond compliance.
So As a consultant to few of the startup companies, and you being a head in a PE firm, I would have like two, three questions from a startup perspective. Like, if we see a startup company, for them, ESG reporting is often seen as something which is very costly. So, for a startup with limited bandwidth, what are the first practical steps they can take, or we can consult them that they should take before visiting a VC or a PE firm?
No, I can you just
As a startup company, what are the first practical steps that they can take
before
considering
before approaching VC
a
or
PE? Yeah, yeah. So, considering their limited bandwidth of
so
funds. Yeah,
uh, companies which have not reached to a stage, I think the easiest would be okay. Maybe if it is, I can, if a company which is into a manufacturing, or let's say if it is into pharmaceutical, small
correct.
outfit,
Yeah,
what the easiest thing is, of course, the BRSR disclosure has made a lot of information public, right? Earlier,
right.
you didn't have that kind of information made public. Now, what
Mm,
they could do is maybe they could go and look at a pharma company, maybe a for company which is in a lower market cap, because a higher market cap company maybe at a very high level of maturity, but pick a company which is into a lower market cap and then look at their disclosures. Okay, that can give a clarity in terms of what policies are required.
correct.
And then the BRSR also looks at what kind of data needs to be tracked, what kind of review mechanism, how are they reviewing, how is the board reviewing, right? Plus, they could look at companies in the same sector, look at the public disclosure, and basis that they can start preparing. In terms of the other area, what they could do is maybe if there is a challenge to have a dedicated resource to look at this, they could give additional responsibility or requirements to certain set of people. So, when a company is in a, let's say, from a low to high growth phase, you will, and we know what are the issues, right? So you have issues around social, so you can ask the HR team to start looking at those things. Similarly, if it is environment, then you can ask your production team or a manufacturing team to start looking at it. So that is the second thing where you ask your existing set of people to start looking at this thing. So I think those two things will help them prepared to get to a stage by which they'll be able to be ready to start talking to a P or a VC kind of organization.
So, do PE firm like yours look at ESG differently when they are evaluating a startup versus when they are evaluating a large corp?
No, only thing is you can look at our policy. Like our policy, it says okay, how much our leverage in an investment is upon how much of equity we are trying to take up. Okay, in a company. So that defines in terms of how do we look at a company. But I don't think we as multiples are differentiating amongst the size of company. But we understand that a smaller company may
Yeah.
have issues in terms of maybe people
Mm,
not understanding issue. They may not
mm,
have, they may have lack of budgets with them.
mm,
So what we do is we try to redraw the plan for them. For a large company, maybe you can say day one, we'll say, okay, you need a board
yeah,
level committee, you
right,
need a data system, you need to
right,
report this data. But a smaller firm, we will
mm,
redraw the plan, we will give them more time to get to that level. We will do hand holding. Like large organization may not need a hand holding on, let's say, carbon footprinting or doing GHG inventorization or collecting this
right,
data. For
right,
smaller companies, we will go and spend time with them, or we will put certain consultants who can help
right,
them get to that level.
right. So, you mentioned during your presentation about three distinct approaches. One was agnostic, sustainable, and the impact
Impact,
investing.
yeah.
Right. So, are we like what is the biggest challenge for a PE fund in moving from ESG just as a compliance or a marketing tool that is an agnostic stage to a ESG which is a true value generator that is the impact stage?
No. No.
What are the biggest challenge
Come back.
um, as a PE
Biggest
fund?
challenge from moving from
Yeah.
agnostic
From
to
agnostic to impact stage.
okay. I think agnostic to impact is like a big, large journey.
Journey,
But
right?
uh, let's say agnostic is a scenario where I have zero consideration
Correct.
for ESG. So for me to move to next level, the first thing what I will have to do is sensitize my own investing team. Okay. The if you understand the business, investing team is all about in their mind, they would want to close investments as fast as possible with
Possible.
limited issues around the deal. Okay.
Hmm.
So the very first step which a PE firm will have to do is sensitize their investment team and tell why this is important, how they can start looking at things like exclusion criteria, which I spoke,
Hmm.
how they should talk to the potential or a new company. Okay, these are the kind of things which we'll ask you to do before we invest, and then during investment phase, again, we'll have certain requirements. So they will have to start preparing to the new companies whom they start talking to. So those are the two steps, and then within a PE firm, one is investing, second is a non-investing kind of team. So you have a fund management team, you have compliance team, you have risk team.
Hmm.
You also have to sensitize and make them ready to fulfill the requirements of around ESG. So maybe training, sensitization, the way in which discussion is to be taken place are the starting point. And then you also need to sensitize your IC committee. So you need to explain them all the requirements, how it is relevant, and how those risks are important from an investment point of view. So those are the kind of actions you can take. And from a, ESG to a impact, it's a big leap,
Correct.
and that can only happen
Over
basis.
the years.
One is, do you want to move towards impact or no? Because what happens is, from agnostic to ESG aligned, you will still have set of investors who will come and join, come and make investment. But impact, if you see the funnel or the pipeline of funds becomes even restricted, because impact focused large investors are again limited globally. So that's a call which companies will have to take.
So, thank you so much, sir, for patiently addressing all our questions. I'm sure all the participants would have gained a valuable takeaway today to apply in their own professional journeys. With this, I would hand over to Preeti to propose a very well deserved vote of thanks. Thank you, sir.
So, good afternoon, everyone. I'm here again. What a knowledgeable and insightful session we had today. And the participation of the audience was quite engaging, and they were fully participating. I can, sense that from the type of questions they were asking. So, now let me go ahead with a formal vote of thanks. Okay. So on behalf of Sustainable Reporting Standard Board of ICI, I extend my sincere gratitude to each of you for joining us today for the enlightening webinar on responsible investment with focus on ESG due diligence. Your participation has been instrumental in making today's session a success. A heartfelt thanks to our esteemed speaker, Mr. Vishal Bhavsar, for sharing his deep expertise and practical perspective on responsible investments with focus on ESG due diligence. His presentation has enhanced our understanding on the concept of responsible investment. The importance of ESG due diligence, which involves risk mitigation, value creation, regulatory alignment, and stakeholders' trust. The discussion this afternoon suggested that ESG due diligence is evolving into a strategic imperative rather than merely a compliance obligation. As investors progressively associate capital allocation with sustainability outcomes, The role of technology and analytics will be pivotal in enhancing due diligence procedures, facilitating comparability, and lowering expenses. Moreover, collaboration among stakeholders, including regulators, corporations, investors, and standard setting bodies, is essential for the integration of ESG due diligence into mainstream practices and for promoting responsible investments. So, I would like to invite all the participants who would like to join us for our upcoming webinar, which is scheduled every Thursday from 3 p.m. to 5 p.m. So, where we'll continue exploring the critical topics on sustainability reporting and best practices. So, once again, thank you for your active participation, thoughtful contributions. Your dedication to advancing sustainability practices is invaluable, and we look forward to continued involvement in our ongoing initiatives. The way we move towards a sustainable and resilient future. So, thank you, everyone. Thank
Thank
you, Hina, for the
thank
and
you.
thank you, Mr. Vishal. Thank you,
Mhm.
the full team of ICI, for having such a
Thank,
knowledgeable session.
yes. Thank you,
Thank
everyone.
you.
Thank you. Support. Yes, ma'am.